Welcome back. This month on Money Mind, we've been going through the vital checklist you need to prepare and grow your nest egg for retirement. After growing funds for retirement, the next step is post-retirement planning. Cho Keng-yut looks at some ways you can protect and even grow retirement income. As people progress through different stages of their lives, their investment requirements change. This means that they have to relook their investment priorities.
I've come across many old people that take on young people risk. The truth is, at that age, maybe in your 50s and 60s and 70s, your ability to bounce back from a catastrophic financial event falls tremendously.
Singapore's National Annuity Scheme, CPF Life, is the first layer of protection, offering a monthly payout once members hit the payout eligibility age. The payout is received no matter what age the CPF member lives to.
The average longevity lifespan is about 85 years. The individual may live much longer than that. So having that lifetime annuity is extremely important because it gives the individual the peace of mind that my money will not run out. The other part that comes along with this is the government guarantee. Many of the private sector solution, even if it's an annuity, it is for a limited period and it is not guaranteed.
There are 3 CPF Life plans. The 2 most common are the escalating plan and the standard plan. The 3rd plan, the basic plan, gives lower monthly payouts but leaves behind a larger legacy for loved ones. CPF Life will take care of basic needs.
The payouts are ranging between 1,000 plus and 2,000 plus. This kind of retirement income is only meant for sustenance. Okay, it's not meant for enjoyment.
Additional income will have to come from other investments. Those who invested in income funds in the run-up to retirement will be able to get a regular stream of income from these investments. There are different types of income funds, including bond funds, asset allocation funds, and equities funds, which pay dividends. Asset allocation funds invest across asset classes like bonds, stocks, and cash equivalents. Market watchers caution that investors should be careful of high-paying income funds that erode capital over time.
When these funds promise over 6% yields, they would need to dip into capital to make these income distributions. Capital erosion would happen. We find that 60% of funds in Singapore that paid above, let's say, 4% regular yield actually had lower NAV at the end of the 5-year period of study.
NAV, or net asset value, represents market value per unit of the fund. It's the price at which investors can buy or sell units of the fund. A lower NAV therefore indicates capital depreciation of the fund. There are other red flags.
Fixed income funds are also more prone to capital erosion because of its lack of ability to capture the upside relative to equity and allocation funds. The very high frequency paying funds, like monthly frequency paying funds, these are also typically have higher payouts than the quarterly or the annual paying funds. And capital erosion has been quite significant there.
Another category of investments that give regular payouts are companies which pay out high dividends. Market watchers warn that not all high dividend paying stocks are sound investments, though.
They actually used to earn a lot of earnings, and they actually give out or pledge to give out a lot of their earnings, which means that they leave very little for their own growth and for their own research and development and so on. When times come like a catastrophic market event like COVID or so, these companies are hit very badly and they have no buffer to fight this crisis. And they have not invested enough for the future for growth.
As retirees relook their equity exposure, they can also consider leaving a small portion in high-risk equities because of the upside potential.
Your retirement time horizon is very long, and stocks will be able to help you beat inflation, grow your capital.
You may be used to a 50-50, 70-30 in favor of higher risk portfolio. That kind of mix can grow down to 30, can go down to 20.
These experts like the S&P 500 and the Nasdaq.
I have a big affinity towards the S&P 500, and that compounds very well over the last 100 years. Yes, it has volatility. From there, you lay on other assets that compounds. You know, the Nasdaq, for example, a globally diversified index or so, and then you try to limit the fluctuations by mixing with some bonds and things like that.
Even with income sources taken care of, good planning means being financially prudent.
For the retiree, the budgeting plan should consider what are your essential expenses that you must spend on, and what are the discretionary expenses that, well, if you have a bit more, you can spend on. A good spending plan should also have some form of reserves, so that if there are uncertainties, at least you have reserves to actually take care of their spending.
Financial planning for a longer and more fulfilling life, the payoff for sustainability in real estate, and bracing for the fallout from the China Evergrande cash crunch. This has been Money Mind.